to a Sense Financial webinar on how to build a profitable, scalable, and sustainable rental property portfolio. My name is Dmitry Fomichenko with Sense Financial, and today I'm joined by Scott Pastel. Scott is going to be our presenter, and I'm going to give him a floor in just a minute here. We at Sense Financial obviously taking care of self-directed retirement accounts, and many of our clients, they invest in alternative investments, including real estate. So real estate fits nicely. I am personally doing that myself in real estate as part of my portfolio. But I asked Scott come in and talk about real estate, building a rental portfolio and how to properly do that. Scott is a good friend of mine. I've known Scott for probably over 15 years now. He's a business owner, he's an investor, he's a public speaker, and he's a licensed real estate agent. He's actually been with Marshall Reddick Real Estate for 18 years. He's been licensed realtor since 2010. He owns multiple investment property in several states, buying a first property in 2009. So he does have some good experience. So pay attention and listen to what he has to say. He has a BS degree in business administrations from Chapman University. And with that, I'm going to give floor to Scott. Scott, thank you for giving us your valuable time, and we look forward to hearing your presentation.
Thank you so much, Dmitry. I greatly appreciate it. And thank you for allowing me to speak on this presentation. And I did get a chance to kind of look through the list. I see some familiar names as well, and some clients we've worked with for many years, and a lot of new names as well that might not be as familiar with Marshall Reddick. So it is a tongue-twisting title. It's quite a long title there, and I think I certainly have done many presentations that had shorter titles. However, building a rental property portfolio that comes along with a lot of objectives, right? And I think for most of us, we look at owning real estate as a nest egg. We look at it as a retirement plan. We look at it as a source of income. But I would venture to say that all of us and most investors are really looking at properties that aren't really going to have to need a tremendous amount of constant work, and really just kind of allow us to have maybe more passive income or as close to passive income as rental properties can. Obviously, we all want profit, but I think there's a happy medium there, and there are the right properties that can allow us to get to financial independence by maybe being able to scale and own 2, 3, 4, maybe 5 up to 10 properties. And there's definitely going to be properties that will eliminate that and prevent us from being able to build a portfolio. If we happen to have a property that unfortunately might be more more problematic than we were hoping. So I feel that all of these objectives are kind of important. Each one is very important. I think that most of us realize we probably cannot achieve financial independence by owning one rental property. And I think a lot of us also realize that we might not have to own 100 either. But I think most of us and many of you that might own rental properties already realize that if you do it right and you get what I like to compare in baseball as a base hit, a second base, third base hit, and you do that a handful of times, and you do that over maybe a 5, 10, 15-year period, and then one day you look at your rental property portfolio and say, well, this is my wealth. Like I've been able to achieve the wealth I have because of real estate. So thank you, Dmitry. Thank you, everybody, for joining. This presentation is usually something I do in an hour and a half, so I apologize if I move through certain things quickly. It is being recorded, and we'll make sure everybody does get a copy of the recording. As Dmitry said, Marshall Reddick has been working with Sense Financial since Sense Financial was created, and I think that was about maybe 2011, 2012, maybe around that time frame. we were, fortunate enough to partner up with Dimitri right when he got started. And now fast forwarding about 12 years or so, we have worked with not just hundreds, we've worked with thousands of clients together. And I love what Sense Financial does. It's allowed so many investors of ours and others to tap into sources of capital that they may not otherwise been able to, and many not even have been aware that they can utilize their retirement account for wealth building and real estate, and comes along with a lot of great benefits. So again, thank you for having me. Dimitri already covered my bio, so I'll just say that, my day job, I call it at Marshall Reddick, is VP of Property Management and Real Estate. That means that I get to interface with our, at this point, 11 property managers in 8 geographic markets that currently, as a company, manage about 2,700 doors. So maybe somewhere around summer or fall, we will be hitting the 3,000 mark. These properties are spread across the 5 states that we're located in. And I say that I'm a public speaker last, an investor and business owner first, because we're really focusing and have focused on having all of these, not just great tools and resources and marketing for investors, but having the actual resource, the ability, the services and the departments that we actually offer to investors, essentially makes Marshall Reddick a one-stop shop. So I get to manage a lot of our realtors, a lot of our property managers, and it's just it's a lot of work, but I really enjoy it, and I get the opportunity to really have a lot of hands-on, focus in the company, and helping to just really continuously build out better processes, and just continuously be the best that we can in the industry. So just real quick, and some of you are familiar with Marshall Reddick. Some of you have actually bought and sold properties, or funded mortgages, or invested in our mortgage fund. For those of you that are new to Marshall Reddick, we have 4 different departments. We are a real estate brokerage, so we have about 75 agents in the 5 states that we're in. Our niche is investment property. We do sell primary residences. We do work with homeowners as well, but about 70% of all of our sales are non-owner occupied investment properties. The strategy that we teach, the strategy that we execute for and have executed for thousands of investors, is long-term buy and hold rental property, which comes along with all kinds of benefits for cash flow, appreciation, wealth building, tax benefits. So that's really the strategy, that we're talking about. That's the strategy that we teach. And we also are a property manager. So that's part of the one-stop shop, is that we locate properties that fit investors' criteria, everything from the acquisitions to going through the escrow process, and then leasing and managing that asset. We're also a private money lender. So we do originate first trust deeds and mortgages, both short-term 12-month loans for fix and flip and new construction. We also finance long-term 15-year and 30-year loans for buy and hold. We also do refinances. We only do non-owner occupied financing. It's asset-based lending, and we have a large team in our office here. So some of you might be working with our private lending department. We don't have the restrictions that we see with conventional financing, and with rates where they're at, we're actually able to compete now on against rates that many people might be shopping with their bank or credit union. Our private lending, oftentimes we can actually beat the interest rates. So, and then lastly, we do have a private investment fund. It's a Reg D 50C3 is the classification. It's a fund. It's a debt fund that we use to actually originate the loans. So we have about $45 million in the fund. All of these services are on our website. I'll be pointing to our website more, but just wanted to give you that quick introduction. And then before I get into my presentation, I have one more, a very important person I want to introduce you to. Sherry Brebner is one of our very talented real estate advisors at Marshall Reddick. She is a licensed California realtor, also owns property. She's been in real estate for 2 decades, has worked with thousands of our clients. Her role is helping somebody, no matter what stage they're in, to set their goals, set criteria, put an action plan in place, provide you with resources and tools that you need to achieve your goals. And basically, you can consider her a consultant. What's great is that there's no charge for the consulting and mentoring that we offer. So her services as an advisor are completely free of charge. Just like realtors at Marshall Reddick, our advisors are paid based on transactions. We do not charge anything for the mentoring or education that we provide. So I'll show her screen again at the end, and I hope that you all have an opportunity to reach out to Sherry, to schedule a phone call, to put some of this in more of a personalized plan, and ask as many difficult questions as you'd like. We welcome that. So now I'd like to get into our presentation. We are going to be covering a number of different topics. I'm going to start by going over setting your investment criteria, which is really just the most important, in my opinion, kind of step in the process is understanding where you're at as an investor and what types of properties fit your goals, and what types of properties don't fit your goals, and really having like a metric and a system to be able to easily identify if a property does or does not fit your goals. So we're going to talk about property classes and setting your investment criteria. I'll be going over just different ways of doing due diligence and researching whether that's on a market or a neighborhood or a community or an actual property. Property management, I consider to be the make or break factor in real estate investing. I consider it to be the X factor, I guess is a good way to put it. It just does not matter how great the property is. This is not a stock, right? This is not virtual investment. This is something that has human beings that need management, that need oversight, and obviously there's a lot of components to properties that need regular attention. So many people would say that property management is probably the most important part of owning rental properties, and finding a good property manager is absolutely essential. So I'll be talking about the property management that Marshall Reddick does and what sets us apart. I will be talking about the locations in the states that we have offices, why we've identified all of these different locations, why these locations are considered ideal for so many investors and for so many reasons. And then I'll actually be showing 3 different example properties, one in different states that we're located in. And I'll be kind of breaking down the numbers. We'll be looking at a pro forma financial analysis on these properties. I'll be explaining like why we pick some of these properties as ideal investments and how to evaluate them. And then lastly, I will be covering different methods of buying real estate. I'll be touching a little bit on financing and some of the different ways to be able to tap into sources of capital to use for investing. So where we begin as an investor, that's certainly a good question, and I think a lot of us struggle on that. And we all know that the first property that we purchase is generally going to be the most difficult. It's new, it's different, we're doing something maybe that we haven't had experience doing before. Even if you own rental properties and you have owned rental properties for many years, we're in a little bit of a different market now, and the markets change. We change as people. Our income changes, our lives change. So it's something to kind of continuously reevaluate is, where am I at in my life right now? What kind of financial benefits do I need? And what kind of properties are going to get me there? So I'm showing you the Marshall Reddick investment methodology. It's clockwise, starting from the left and going all the way to the right. This is a step-by-step process. So we're meant to follow the order here from why to how to when, all the way to who. And what we're doing here is we're defining, and we're individually in a very personalized way defining each one of these. We're defining why we're investing in real estate, defining how we're going to do it, defining when we're going to do it, defining what type of property we're buying, where we're buying it, and who we're going to work with. Simply put, I feel like this is just like the complete circle of investing in real estate. And it's important that we work in this order and that we're able to articulate each one of these so that we really have a better understanding of where we're going. So I call this, our investment methodology. I also like to refer to it as the why, how, when, what, where, who matrix, because every investor needs to be able to identify every single one of these before they actually make an investment. So I'm going to be touching on each one of these steps here. And we're going to start actually, rather than starting with the goals, because that's something that our real estate advisors help with. It's something that you may already have some idea in mind on what your goals are. I want to start with talking about what types of investments make sense for each individual investor. So we've all looked at properties on Zillow and Redfin and Realtor and all these different websites, and maybe many of us have also looked at listings on the MLS that realtors have sent us, and we're analyzing and we're evaluating, and we're all just trying to figure out what are the best deals out there. Well, the real question is, what's the best deal out there for me, and why is that the best deal for me, and exactly what am I looking for? So we got to put some clarity on that. We can't just do what someone else is telling us to do, because it's just not going to click. So when we look at properties, there's all these different factors that go into a property. It's the price of a property, the age of a property, the condition of a property, how many bedrooms and bathrooms, and is it in an HOA? Does it have a view? Is it a corner lot? There's all these. I mean, when you look at a listing, there's over 100 fields on that listing, and really you don't see the most important one. The one that we're not seeing is that second one on the left that says property class. Zillow and Realtor.com and Redfin, they're not going to tell us the property class. Property class relates only to investment real estate. And it's something that, there's not even a lot of consistency in the industry on. So Marshall Reddick Real Estate, myself, our CEO, and some of our executives wrote a book many years ago. Now, we're on 8 years now that we wrote our property rating ebook. It's a timeless ebook, completely timeless. So everything in it is relevant 8 years ago. It's just as relevant today. It also works in every single city and state in the entire country. So it doesn't matter what market you're in. It doesn't matter what year you're in. It's all very timeless information. And it's entirely based on what an A class, B class, C class, and D class property is, and exactly what that comes along with in terms of maintenance, vacancy, cash flow, appreciation, tenant quality. So pretty much like the main risks that we care about, maintenance, vacancy, tenant quality, are all based on property class. So the next slide here is the property rating scale. And you can use this in any city in the country. It's meant to be used in major metropolitan markets. In fact, one of my very strong philosophies that I'm going to share is only buy property in a major metropolitan market, and I'll explain why a little bit later. But this property rating scale can be used in every single metropolitan market in the country. Essentially, it's based on the median home price in that respective market. And next slides are going to show exactly, where and how to get the median. But just really like conceptually speaking here, higher property classes will tend to see more appreciation and value over time. Lower property classes will tend to see less appreciation over time. But as a trade-off, we might see more potential for positive cash flow. And higher property classes will have a much higher variance in the difference between the monthly rent and the purchase price, which creates less opportunity for positive cash flow. Now we see higher tenant quality on the left, lower tenant quality on the right, and then higher prices on the left, lower prices on the right. I want to kind of put a visualization here. And if we look at a property that's in a C-class property, generally the majority of the properties in that community or in that area are going to be rental occupied. Versus an A-class property, when we look at that kind of a property and then we expand in that neighborhood, the majority of those homes are owner-occupied. We don't see homeowners associations in like C, D-class properties. It's much more common to see in A-class, luxury class properties. So there's an extra layer of accountability in the neighborhood to, preserve the quality of the entire community in these homeowners associations. But that's not just really it either. We see higher higher school district ratings and higher property classes. We see lower crime rates in neighborhoods and communities that are A-class. And, this is a buy and hold strategy. And going back to our title here, most of us are going to own our rental properties for at least 10 to 15 years or longer. It's very, very common that we'll own a rental property for less than that. So the average investor owns their rental property somewhere between 10 to 15 years. That means we might have 5 different renters, we might have 8 different renters, we might have, who knows, right? But we're going to see some tenants moving in and out, and we need to be able to qualify these tenants off income and credit and criminal background and all of these different factors that prove that we have a good quality renter. Well, it's much harder to do when you're in lower property classes. So what I'll do here is kind of just cross out. I don't have a little drawing tool that I'm using for it, but I'm going to just mentally cross out D-class and cross out luxury, because D-class is not going to provide us an opportunity to make money. This is where we lose money. This is where we run into evictions and long periods of vacancy and damages and just all kinds of nuisances that no investor wants to deal with. Luxury class is generally going to be a home that we hopefully live in, like our primary residence or a dream home. It may not make sense on paper to purchase that home as an investment. So there's going to be a little bit too much speculation, and probably the only way we can get that to cash flow is with a significantly high down payment. So for investing, it really only makes sense to look at A, B, and C. And I have some questions up above that are questions that our advisors ask to help point people in the right direction to say, well, based on your experience and your duration of time until you retire, and whether you have dependents and how many sources of income you have, we'll point you in this direction. Or we might say, you have 30 something years until you retire, you have, great income. Maybe what will benefit you is more wealth building. So let's look at A-class properties. So it really is dependent on the investor. So we as in Marshall Reddick, because we have the data from the National Association of Realtors, the median home price in every single metropolitan market in the entire country. That's easy to find, and it's data that's on our website. It's data that we share. It's actually data that you can also get on realtor.org, which is the National Association of Realtors website. I'm going to share the website on our I'm going to share the landing page on our website that you can download the ebook, but you actually can click on different links in there, and it'll take you to the data where all of the median home prices are located. So we take the median home price in any market that we're looking at. Now we take the subject property, we divide that by the median, and the subject property is going to be somewhere in that top scale. That top scale is for single-family residences. The bottom scale is for multi-units or apartments. The data is actually based on detached single-family homes, which is why we adjust the property rating scale when we're looking at a unit in a duplex, fourplex that has shared walls versus a detached single-family home with a private backyard and no shared walls. So let's just say we're looking at a property in a market, and that median home price in that market is, let's just say, $400,000. So if we're looking at a market where the median's $400,000 and the subject property we're looking at is listed or valued at $420,000, we know it's above the bracket between A and B, so it's somewhere in A class. Versus a property that we're looking at around $200,000 in that market is right in between C and D class, and anything below $200,000 is considered a D class property. It's not necessarily based on the age, condition, or size of a property, and that's something that you will be able to learn by reading our ebook. This is a screenshot of one of the pages in the ebook. So that's a screenshot of the NAR website that has all of the metropolitan markets. You can click on that screenshot there in the ebook, and it'll actually take you directly to the website where you can get all the median home price data. I kind of covered this already, but tenant quality, what I mean by that is like job stability, credit, income compared to the monthly rent, criminal background, landlord history, sources of income, is there dual income, how are they actually drawing income? So a lot of those things go into tenant quality. What we basically see in like D class is that these are going to be like either Section 8 or below the poverty line. What we'll see with C-class is typically hourly wage employees, maybe more blue-collar employment. B-class is going to be kind of like median salaries in that respective market. They could be any type of person, but they're somewhere around the median income. When we look at A-class, we do definitely see higher probability of dual income, of white-collar employment. They specialize in a certain field. There's also a higher probability that they've owned real estate somewhere in the past, and they might have experience actually taking care of a home that they own. We got this data because you can imagine managing now almost 3,000 properties. We average about 300 applications each month, and we're in a lot of different locations. So when we wrote this ebook, we saw a lot of consistency between applications in all of these different locations that had nothing to do with the location, the city or state, but had everything to do with the property class. And we know certain high-priced markets, I'll take LA or San Francisco, we might see median home prices around $1 million. So, what's a $500,000 property in California being C or D class could be an A class or even luxury class property in another market. So it's important that we understand the median home prices, how the subject property relates to the median, because we maybe only are familiar with our own area where we live, but when we start branching out and looking at the whole US, we really have to have a metric to be able to help us figure out what exactly we're looking at. And property class really does not have much to do with the aesthetics of a property. If you see on there, what matters is the school districts, crime rates, the demand for people purchasing real estate in that neighborhood. And cost per square foot and price points are driven by supply and demand. The more demand of people buying, prices go up. The less demand of people buying, meaning more people are renting, prices don't go up as much. So it's important to understand that. And if you see at the bottom, A class, I think it's awesome that these actually equate to a great kind of abbreviation here, but A for appreciation, B for a combination of both, and C primarily will provide cash flow. It just really depends on what you're looking for. There's a reason that we evaluate all this. It's because different property classes are going to have different amounts of maintenance and vacancy. Higher property classes will have lower, and vice versa. So as conservative investors, we take the percentages that you're looking at here, 1 to 4 unit at the top for residential real estate, 5 and up will be considered commercial apartments. We take these percentages, we multiply them by the monthly rent, and it's just really a reserve that we want to have in mind. We're not going to be paying a maintenance fee. We're not going to be paying a vacancy fee. In fact, we might go months without maintenance or vacancy, but eventually it will happen. And if we're going to be owning this property for 10 to 15 years, we know that the longer a tenant stays in a property, typically the more work that property needs when they move out. So we may have not very much maintenance and repairs over the course of that 3, 4, 5, 6 year period. But when they move out, we have to redo the flooring and we have to redo the paint. We have to, change out an appliance. And, at that point, we might be looking at a higher turnover fee than maybe a tenant who was only in that property for 1 year. So it's really a trade-off. And we have to be able to, make reserves here for these periods of vacancy and maintenance that we will experience over time. And the key to owning investment properties is that the only time you use your own money is when you acquire the property, the down payment, the closing costs, the initial repairs. If you do it right and you've got a cash flow on that property and you've got a property that's in a nice area that will see rent increases and growth in value over time, then you should only have to use your maintenance and vacancy reserves to cover those months of vacancy or to cover those repairs. And really sticking to the right properties, meaning properties that don't have significant problems soon after owning them, is a big, big key. We don't want to have to do roof work or roof repair or plumbing or HVAC for many, many years. And ideally, if we're doing this right, we're buying newer properties or properties that have had recent updates so that we don't have to shell out huge amounts of money, our second or third year in owning that property. So, that's all part of the evaluation and making sure we're buying the right properties. So how we evaluate vacancy is you can take any of those percentages and multiply them by the number of days in a year. And that's how many days we're actually just setting aside for vacancy each year. Again, we don't always know if a tenant's going to stay for 1 year or 10 years, but it's very prudent to follow the property rating metrics here, so that when we are evaluating a property before we make that investment, we want to have some predictability. And we're going to be looking at our bottom line return. We have to be factoring in accurate or realistic reserves for maintenance and vacancy, so that we don't just assume we're going to be making a very, very high amount of cash flow and we look at it after 2 or 3 years and go, why is that so much lower than I thought? Oh, it's because I didn't factor in maintenance and vacancy. Well, we got to do it up front so that we have a much more realistic idea of what that return or what that cash flow return is going to look like as the years continue. So at the bottom of the screen here, it's a very easy URL here at the bottom. It's just marshallreddick.com/ebook. Takes you directly to be able to download this for free. It's about 40 pages. I would say it's pretty much the most informative read that we could provide. It has tons of data and links in it that take you to the sources that we are putting in this ebook. And one of my biggest recommendations after tonight is that you all get the chance to read this ebook. It's designed so that after you read it, which might only take an hour or two, you have a much better idea of the types of properties that fit your goals. Okay, I'm going to cover, I've put up here about 6 different methods of buying investment property. Top right there, we've got self-directed retirement accounts. We work with a lot of investors that set up solo 401ks and checkbook IRAs with Dimitri, because he's absolutely, I think the industry leader in this subject. That could be one way, and that might be a way that many of you are already utilizing, and a way that you guys are tapping into different sources to be able to buy real estate. For us, many of us are going to look at conventional financing first because that offers the lowest down payment and typically the best interest rates that we can get. We know that there's limitations, and many of us are business owners or own a lot of properties already. We might have many sources of income, and it can be very challenging in some cases to qualify for conventional financing. We're definitely going to offer that and suggest that as a good starting point. But if that's not going to be an option for some of you, we're going to look at alternative financing, and that's going to be our in-house private financing. That is essentially not credit-based. That's purely asset-based, and it's based on the net operating income of the property. We underwrite properties in our office. Down payments start as low as 30%. You can purchase with an LLC. You can purchase with a retirement account. You can purchase if you're self-employed and write off a lot of your income. You can use private financing no matter what your citizen status looks like. So that really opens up a lot of opportunities that some investors are not able to benefit from on conventional financing. Of course, cash is always an option for investors who have the funds to purchase in cash. And then 1031 exchanges. We perform and constantly perform 1031 exchanges. And that's something that, again, our advisors evaluate the portfolio of an investor to say, what are your best performing properties? What are your lowest performing properties? Why is this property not performing? Have you changed property managers? What's the issue? Or maybe just a property that has already seen a tremendous amount of equity, and we can take what might be, let's say, like $4,000 a month of income on that property and turn it into $10,000 or $12,000 a month by exchanging that into a portfolio of real estate that has a much higher cash-on-cash return. So we're very familiar with exchanges. We work with one of the industry-leading 1031 exchange intermediaries, and have done, I would probably venture to say, well over 1,000 exchanges in the last 20 years. So we have a great partner. Many of you may already know Reed Hazard and CMG Mortgage. They are our preferred conventional lender. There's many reasons why they are our preferred mortgage lender. Basically, I think service and rates and fees come first. We haven't been able to find a company or a lender that offers even close to the same level of service and the ability to get rates and fees at such competitive prices. So, we're always going to open up that opportunity and connect you. And if you have a lender you already work with, great. We always recommend to get, at least another quote to compare. So we're looking at down payments here. And, you can actually on a single unit property go as low as 15% down, but you are going to pay private mortgage insurance on that because it's less than 20%. So we really do recommend at least 20 to 25% down. In fact, if you're able to put 25% down on a single family, you're typically going to get a little bit of a lower interest rate. But you can go up to 10 finance properties with conventional. As you get to 7 properties that you have in your portfolio that are financed, they do increase the requirement for credit scores. So they're going to want to see at least 720 FICOs when you're up to about 7 properties, and the down payment for 2 to 4 unit properties starts at 25% down. I just like to share this for a minute. I think it's just a great graph to kind of get our really an overview of what interest rates have looked like in the last 50 years or so. And many of us are familiar. Maybe we can think back to the early 80s and the savings and loan crisis when rates were in 18%. Historically, though, rates have been at about 6%. And interestingly enough, that's kind of where we're at right now. And we can actually get rates here at Marshall Reddick. We can get rates in the 5s with a buy down from the seller. So we're able to get rates quite a bit lower than what we see on the indexes. But yeah, I mean, it's kind of back to where rates were around maybe like 2006, 2007, when I bought my first property, which actually I contracted on it in 2008, closed in 2009. My interest rate on my first property was 6.25%. So really not much different than where we're at today. And I did refinance that, several years later when rates dropped. So we always say you date your interest rate and you marry the property. You can't go back and change what you paid for a property. But, as rates do go down over time, we always have the opportunity to refinance. So rates are not permanent, but obviously the price that we pay for a property is. And in this market that we're in right now with a lot more opportunity for buyers, we're able to get deals that were nothing that we could even dream of getting a year or two ago. Inflation is definitely tied to interest rates. And many of us have been following the Fed and their meetings, and they're increasing the federal fund rate, all designed to slow down inflation. And the orange graph on there is the CPI inflation rate. The blue graph is where the 30-year fixed mortgage rates are at. A lot of similarities here, and I think a lot of us realize that if we can continue to see inflation cool down, I think the consensus is that the Feds will hopefully pull back and realize that, we can hover maybe around a healthy 5% interest rate market, which to me, I feel like is a very healthy market when we're in rates around the 5s. We'll probably never see rates in the 2% again. I don't expect to see that for a very long time. That's okay. I think if we look at historically where we've been, I think many of us see the opportunity is still there with rates in the 5s. It's just when you get up to what we saw, 6-7 months ago, and where the index has been, it makes it a lot harder when we're at rates in the 7s and 8s. But I think we're cooling down here a little bit. So a lot of optimism coming up this year for most of us. Now that we kind of gone through setting our criteria, going over property classes, figuring out how we're going to buy real estate, it's time to look at some of the best markets. And, we're not all going to agree on markets to invest in. Our goals and our criteria will lead us to different locations. But without a doubt, there are absolutely states, cities, and locations that are very, very pro-investor, and locations that are very, very anti-investor. And you can look at different things like property taxes and landlord-tenant laws and weather patterns, and say, does it even make sense to invest in some of these locations? So our company's been around since the early 80s, so very, very long history here. In 2014, Marshall Reddick retired. Myself and my partner, Ross Nelson, took over the company, and that's when we started expanding into other locations. So we set our sights on Texas, Tennessee, and Florida primarily as three of the most business-friendly, landlord-friendly states in the country. Our headquarters has been and still is in California. We have locations all throughout California. We sell investment property in California. However, I will also say that the majority, and what I would consider to be probably 80–90% of our sales are in the Texas, Tennessee, Florida markets. And that's where we offer the ability to buy and sell properties in any of these locations with the same company, all under one roof. And I'd like to explain why we chose locations like Central Texas, Northern Tennessee, and Southwest Florida as our locations to set up teams and offices and conduct business. So first and foremost, when you're really looking at buying property as an investment, not turning your primary into an investment, but buying a property as an investment and having no intentions of living in it, when that's your goal, you really want to look at where does it make the most sense? Where can I stretch my dollars but see that property appreciate in value over time, always have rental demand, have a huge tenant pool, have many different industries in employment to support the job market. So we're going to look first and foremost at the job market, the unemployment rate, all of the economic diversity in a market. And we're not going to see this in small little towns that are 2 or 3 hours away from a major metro. We're only going to see this blend that we look for in major metropolitan markets. We're only going to see a diversity of employment in major metropolitan markets. We're only going to see a large tenant pool in major metropolitan markets. What's great about it is there's a lot of locations across the U.S. where the affordability rate is significantly higher than I think where maybe many of us live. It's certainly higher than where I live in Southern California. So, when I was much more naive and green in my investment days many years ago, I, like many others, started looking around in my market and realizing that there was absolutely no way. The barrier of entry was too high. I couldn't build a rental property portfolio in such an expensive market. So branching out into locations like Texas, like Florida, like Tennessee, allowing us to buy properties that are actually lower than the U.S. average. And in fact, the majority of homes that we sell in these territories are anywhere from about $200,000 to $400,000 on average. We might see some, slip in a little bit higher, but I would say probably 90% of all of the single-family homes we sell, and we sell about 50 to 80 a month, are going to be somewhere between $200,000 to $400,000. So absolutely, we're closer to the affordability rate that I think most of us look for. In metropolitans like we're in, that's where we're going to see colleges and universities that attract students who will enter the workforce. And in a major metropolitan market, we're not the only property manager in town. There's a lot of competition. That's a good thing for an investor. You want options. You don't want to buy a property in a small little town of 8,000, 10,000 people, and there's 2 property managers, and you're stuck. And you don't want that. You want to be able to always have that competition in management, fighting for your business, so that you can always have options. Okay, so now we're at the locations. So circled in green are all of the offices that Marshall Reddick has. So these are our brick and mortar offices in all of these different cities. So we're in Northern California. We are also in the Inland Empire. We cover parts of Riverside, all of Orange County, all of Los Angeles County, most of northern San Diego, and parts of the Bay Area. So we do have a lot of clients who own properties. We manage about 300 properties in California. Now I'm going to move towards Texas. We're in Central Texas, which is San Antonio, New Braunfels, and Austin, as well as Houston, Texas. We are not in Dallas. That's the one metro in Texas that we are not in. I can always explain that in another day. But we're also in northern Tennessee, which is Nashville and Clarksville, Tennessee. And lastly, southwest Florida, which is Fort Myers, Cape Coral, about an hour north of Tampa, an hour north of Naples, about an hour and a half south of Tampa. These are markets that fit everything that we've been looking for. We've now had offices in these locations for many, many years. In Central Texas, we're at about 1,500 units under management. In Northern Tennessee, we're at about 350 units under management. In Southwest Florida, we're at about 600 units under management. So I think I added that math up. We're somewhere around like 2,600, 2,700 units under management. And, we have really fine-tuned the neighborhoods, the communities, and exactly the locations on a very micro level of where it makes sense to invest. We've got these 4 other markets: Phoenix, Indianapolis, Memphis, and Dallas. These are our third-party markets. We are not located in those locations. We do have referrals, and we have some referral partners we've worked with for many years. One of them is I own a property in Phoenix. It's being managed by the same referral partner we've had there for about 12 years. So we do have access to these other locations, but if you're looking at buying or selling in any of these territories that are in green, you're going to be working with a Marshall Reddick staff member in a Marshall Reddick office, which brings me to one of my favorite slides. This was all taken in December. These are our team photos. On the top left, that's our Central Texas team. That is actually just our San Antonio team, a mixture of property management staff members, leasing agents, realtors, maintenance managers, all service team members in our real estate and property management department. Top right is our Southern California, Los Angeles, and Orange County team. Again, these are going to be a lot of realtors, leasing agents, property management staff members. We also have our private lending team that operates in our Orange County office. Now going down to the bottom left, that is our Clarksville, Tennessee team. In the middle there, we've got our Fort Myers, Cape Coral, Florida team. And on the bottom right, that is our New Braunfels and Austin, Texas team. So combined, Marshall Reddick has about 125 employees, split, pretty close to 50-50 between our 1099 realtors and our W-2 employees. We've had so many people visiting these locations. We always encourage it. We make it possible to not have to, and we have actual clients in about 20 different countries across the world, in far away locations like Israel and Hong Kong and Canada and Turkey and Costa Rica and Japan and in many different countries. So, we make it possible to own real estate in our territories, no matter where in the world you live, maybe even in Mars one day. But these are the locations that we service, and we have clients all over the world. So if you're ever looking to visit, we'd love to have you. But you will likely be talking to some of the smiley faces that you see here on the screen. So kind of getting into a little bit further on some of the territories, our model is to target the suburbs of major metropolitan markets. So the aerial map on the left is San Antonio. We can also see New Braunfels there going northeast on the I-35. We can even see San Marcos there on the top right. And Seguin, Texas, which is just a little bit south of New Braunfels. These are very rapidly growing cities that New Braunfels especially is looking like it might be its own metropolitan market in the future. But, and then we look at Austin. Austin, most of our properties are going to be in North Austin and South Austin. We do have some properties in the downtown, but not very many. And same thing with San Antonio. I mean, we may have maybe 15, 20 properties in downtown and hundreds and hundreds and hundreds that are outside of the downtown, more in the suburbs, looking at northwest from far west San Antonio, going clockwise to the medical district where USAA headquarters is located in cities like Helotes, all the way to the northeast in Selma, Schertz, Converse. These are really the locations that we stick to. And you wonder, how come there's like no property south of the 10 freeway and almost all of them are north of the 10 freeway? Well, that is where the quality of long-term tenants has guided us. That's where we see more consistency in the neighborhoods, in the tenant quality. That's where we see tenants who have good income and good credit are looking to live in some of these communities that might be considered a little bit safer, where the downtown obviously kind of has a much more of a mixture. So these little icons are all properties that we manage, and I like sharing it because the types of properties that we suggest are already going to be in communities and neighborhoods that we already manage property in. So we're not testing anything out. We're not just saying, hey, I wonder, if it's a good idea to buy a property way out here. No, we've already identified the locations that we're in. We already know our geographic boundaries. We already know the neighborhoods. We know the days on market. We know the tenant quality. We know the demand. So there's a tremendous amount of research and knowledge that goes into this. And occasionally we have people that ask about territories that are maybe far outside of our geographic range. And unfortunately, we just can't do it. We stick to very specific boundaries and very specific parts of town that we look at. And we do that because we manage the property. That's the accountability. We're not just selling a property like a traditional realtor and saying, good luck, hope it works out. When we close escrow on that property where the average realtor's job ends, our job begins. And it's now time for us to do the renovations and repairs that the property needs, get it listed on the market in a timely manner, start those showings, keep the owner updated, generate that approved application and place that renter, set the expectations, write a robust lease that has all of the necessary terms to protect the landlord and our management company. That is not an easy task. I'll be the first to say I think it's harder to find a good property management company than it is to find just about any other type of professional service. On one hand, I think that allows us to set ourselves apart. On the other hand, we're in a difficult industry. So the flyer that I'm showing you on here kind of compares you the fees that Marsh Reddick has versus the average property manager. Well, I kind of want to explain it here because a lot of property management companies only do property management. That's their only source of income. That is not the case at Marsh Reddick. We have a lending department. We have a real estate department. The reason that we did property management, because we didn't 20 years ago. We started doing property management almost a decade ago. And the reason was because we could not find a good property manager in any of our markets. They were good for a little bit, and then their quality started to deteriorate, and we'd have to find another one, and same thing, and we would just go through this vicious circle over and over again. And we realized that, if we're going to be able to provide our clients with the returns and with the consistency that we want them to, we're going to have to do it on our own. So that's what we did many years ago. We're at, as I said again, about almost 3,000 units under management with a staff of about 60 people in property management alone. We do not view our property management as a profit center. We view it as certainly something that needs to break even, but an opportunity to provide our clients with very competitive pricing without having to add all these nickel and dime fees. So our pricing it's very simple. We have basically just 3 fees for the monthly management, the leasing, and lease renewal. And you can see our property management fees directly on our website. I do want to cover what it is we actually do. And there's many, many things. I've kind of summarized it on here. First and foremost, we protect the privacy and identity of our landlords, and we write the lease on behalf of the landlord. As a landlord, you don't want your name out there. You don't want your face out there. You want to hire a company that's your agent, your representative, and they're doing everything on your behalf. We take on the brunt of the responsibility and the liability. We're the ones that decline applications. We're the ones that post 3-day pay or quit notices. We're the ones that post notices of entry. We're the ones that send notices of non-renewal. We're the ones that implement late fees. We're the ones that implement early termination fees. We're the ones that have to have difficult conversations every single day. And that's what we do. That's just part of property management. We get kicked in the face every day. It's just what we do. And we have to hold tenants accountable. And we can't, bend on certain things like refunding a security deposit, right? We know exactly how much we're supposed to take out of a security deposit. Is a tenant going to agree with us every time? Of course not. Do we document every single thing and share the move-in inspection and the move-out inspection and an itemized estimate and pictures and notes and showing them why we deducted exactly what we did and then not hear from them again? Of course. And it happens all the time. And, you know, I mean, I could not be more adamant about not self-managing properties. I don't self-manage my properties. I've been in real estate for 18 years. I'm the VP of a company that manages 3,000 properties. I will never manage my own properties. That goes for a property that I could own across the street from me. And I hope to own rental properties in my neighborhood one day. I will never manage properties in my neighborhood one day, ever. I want to have the peace of mind. I don't want my tenants knowing that I'm the landlord. I don't want that kind of relationship. I don't want that kind of liability. I want a company that is the face of that property. I want a business that has eviction attorneys and collections companies and contractors and software. And that's how this has to be treated. So when we're looking at scaling a rental property portfolio, there's absolutely no way you can do it without having a professional management company. And yes, you have to have a good property management company, but there's absolutely no way to do it without. And companies like us have hundreds of vendors and vendors that get a massive amount of business from us and that provide good pricing and good turnaround times because they're getting constant business from us. And that's a very, very key point, is that our vendors don't work for us. They're not on our employment. They're not on our payroll. We don't generate any revenue whatsoever from them. They're our preferred vendors, and we've got a handful in each category and each geographic location. So if we have the need for a plumber in Converse, Texas, we probably have at least 5 plumbers in Converse, Texas. Emergency plumbers that, you know, we can get out there and one might be busy, but the other one might not be busy. So we have backup vendors in every category because we're going to get multiple bids for things. Anything that's more than just a few $100s, paint, flooring, appliances, we're going to get multiple bids. We're not married to any one contractor. That's the kind of property manager that you want to work with. And of course, I can talk a lot more about property management. I want to be mindful of our time here. Look up reviews, right? You want to look up reviews of a property manager. Look them up on Yelp. Look them up on Google. Read what landlords and tenants are saying about that company. Of course, tenants are more likely to post experiences that might not be positive, but it's important to also read, you know, how was this responded to? Did the property manager respond to that review? How did they respond? But I'm going to go right to that one on the top right there. Is there a maintenance conflict of interest? A lot of property management companies do repairs in-house. They have a general contracting license. They profit from maintenance and repairs. That's a huge conflict of interest. The only good property management landlord relationship is one in which the property manager only makes money when the landlord makes money and doesn't make money when the landlord loses money. We don't charge fees during vacancy. We don't have markups for maintenance and repairs. That's exactly the kind of property manager that you want to work with. So how do we measure the success of each investment property? So on our website, marshreddick.com, you can download the 25-year historical median home price history of all the major metropolitan markets we're in and many, many other markets in addition to the ones we're in. So these are graphs you can also get on our website. The table on the right correlates with the graph on the left, and we're seeing median home prices year over year. Well, San Antonio is very unique when you compare it to most markets in the country. And what we're really looking at is a very stable, steady growth. And what really stands out is the home price changes in 2008, 9, and 10, when a lot of markets saw 20, 30, 40, 50, 60% decreases in the Great Recession. Some markets, not that many, but some markets like San Antonio and Austin and other parts of the markets that we're in didn't see a drop at all. And then right back to positive appreciation, but very stable, steady appreciation. That's a safe market. Somebody asked me, hey, what's a safe market to invest in? I'm going to show them this graph and say, that's a safe market. That's a market that has no volatility, that has seen positive appreciation every year for 25 years and basically had almost no drop in 2008. So now we're looking at median home prices on the property class graph. We know if we're around like in the 300s, we're in A class, and all of this is again on our website. So This is a duplex. The picture is a little bit misleading. It shows one side of the duplex. It's actually, this is a full duplex for $575,000. We work with this builder. We're the preferred property manager and real estate agency for a private duplex builder in Central Texas that has many different communities. We like newer properties, as do our investors. They come along with a builder warranty. Renters love new properties. We don't have issues with those major ticket items like plumbing, roof, HVAC, for many, many years. So if you're also an investor just kind of looking for the most passive investment possible, we'd probably recommend new construction property because it's going to be a very long time before we see some of those large ticket items. These duplexes, these are actually the higher priced ones at $575,000. They start actually like in the mid 400s because there are many different developments and communities that we have these in. They range from about $450,000 up to about $575,000. The value there is the land and the location. The higher priced ones are also going to have higher rent. So these are the highest rental duplex units that we see. The gross rent of the duplex is about $4,000 a month. That means we're seeing rents on each side at about $1,995 a month. And you'll be able to see this financial pro forma on all the properties in our website. We need to take into account the taxes, insurance, property management fees. There is an HOA fee in this community. So when we take the rent and we subtract all the fixed expenses, we're left with about $459 a month in positive cash flow. Not to mention, this is an A-class property that we should see a lot of appreciation over time, and it's a new property that should experience very little maintenance. The phantom expense on the bottom there, the estimated monthly cash flow, that's really not an accurate number. That really just shows what a month would look like with maintenance and vacancy, which we're not going to experience every month. So we want to be able to set aside those reserves, and I recommend setting up a separate bank account for just solely for your real estate investments. Fund it with maybe 3 to 6 months of cash reserves. Have a property manager direct deposit it directly into that account so that the rent is going directly in there. Set up your mortgage payments on auto pay so your mortgage payments are coming out of that account, and all income and expenses going in and out of that bank account. It's very easy to set up a separate bank account wherever you bank at, Wells or B of A, U.S. Bank. I have an account that's just for my real estate. And I don't think you need to do this for each property. If you want to, you can. I think it's a little bit more to manage there, but I would definitely recommend setting up a separate checking account just for your real estate. That way you can see the performance of your properties over time, and it's just income in and expenses out on your rental properties. These are great properties. You can explore these duplexes more on our website. We have hundreds of example properties on our website. So now we look at a different market. So Southwest Florida, which looked more like Arizona and Las Vegas and California, and really most markets in the country that have seen ups and downs in the market. Fort Myers is, it's not the largest metropolitan market we're in. It's still a major metropolitan market with a lot of major tax benefits and really good favorable property taxes. This is a part of Florida that, of course, there was the Hurricane Ian that we saw in October. We've seen major turnaround in this market. We only had a few properties that really experienced significant damage out of a 600-unit portfolio. The rental market is extremely strong there. We have not seen values or rents decline since the hurricane. And it's really a part of Florida and Southwest that has traditionally not seen nearly the activity of hurricanes that East Florida has seen. So we still believe very strongly in this market. We see a lot of great opportunities for properties like this. This is a D.R. Horton new construction, 4-bedroom, 2-bath, 1,800 square foot home for $355,000. That number, the purchase price is crossed out because the builder is paying some concessions to the closing costs and also a slight reduction in the purchase price. So we are heavily negotiating with builders, and third-party sellers to try to get the best deals possible. And in many cases, that's going to mean, closing costs paid, maybe a rate buy down. And these are things we're negotiating up front. But these are great properties. We manage quite a lot of these. Rents on these are typically going to be between about $2,400 to $2,500 a month. The rental market has exploded in Cape Coral, Fort Myers, Florida. And certain properties like this, they do come along. We have some properties that we're offering a promotion for 1 full year of free property management. You can talk to Sherry Brebner and look at properties on our website, or talk to Sherry to see which properties come along with that. But we've tried to, heavily incentivize investors to say, hey, the deals and the opportunities are still out there. We believe in it. We believe in it so much that there are properties that we are willing to manage for free for an entire year, to help investors realize that the opportunities now are amazing. Clarksville, Tennessee, which is just outside of Nashville, Tennessee, is a market that we're also in, also very stable, steady market. This is going to be our most affordable market with median home prices in the low 200s. So for beginning investors, this is going to be the lowest barrier of entry. Also low property taxes, low insurance. Property example here, $320,000 property built in 2000, 2,300. This is a third-party property. This is not our listing. We look at properties on the MLS, on the open market quite a lot. And generally, a property like this is going to be located in a neighborhood that we manage other properties. We're already familiar with these locations. At 30% down, a property like this, we can see about $300 a month in positive cash flow. That 5.75 interest rate does assume a rate buy down, which again, we're able to get in many, many cases paid by the seller. All right, I know you guys have stayed with us here a little bit past 7 Pacific, so I just kind of want to summarize a couple things. Some of this I have covered already, but we do have an ideal model for a tenant, and that ideal model is a family. And because that's our ideal model, we stick to 3 to 4 bedroom homes. We know that long-term tenants are not necessarily going to look for 1 and 2 bedroom properties. They'll be much more inclined to look for 3 to 4 bedroom. 5 bedrooms rare. There's a much smaller rental pool, so we generally stay away from 5 bedroom. But the average type of single family home that we sell is a 3 to 4 bedroom, 2 to 3 bath, 2-car garage, detached single family home, on average about an 8,000 to 10,000 square foot lot, private fence in many cases, no pools in many cases to lower the liability. And we're doing that because we want a long-term tenant. We want a good quality long-term tenant, like a family that might also have dual income, and they might even have children or expecting children to eventually join the school districts. Well, that's terrific because we're generally going to see those tenants stay for a very long time, build relationships in the community. They're only going to be looking at properties that have decent school districts, low crime rates, and many times they're looking at properties that are in new communities. So that's our ideal tenant. Wrapping up here, last few minutes, I want to throw out some resources. I'm going to leave you guys with a lot of great resources here. All of the locations we're in, each year we update our market data packets. They're about 20 pages each, and it's got a lot of data, demographics, major employers, median home prices, major attractions, history of the market. You can download market data packets for free, any of our locations, on marshreddick.com/market data. We also recommend that you guys use our financial calculator. You can find that on our website, marshreddick.com. If you click on the Learn tab at the top, there are several calculators, and we spend a lot of time and money building these, and we think that they are probably the superior financial property calculator in the industry. Lastly, I mentioned already that Marshall Reddick is a one-stop shop. These are all the players that we put together to bring you a team of people that work together and have worked together for many, many years. That's going to be our advisors like Sherry, our lenders like Reed, our realtors that we have in all these locations, preferred building inspectors, insurance agents, property management. It all goes together. All of this comes in a package at Marshall Reddick, and it comes in a package in many different locations across the country. These are different, I call them like maybe golden rules or investing principles. We kind of talked about some of these already. I recommend only working with a company that does both the sale and leasing and management. There's a lot more accountability there. If you bought a property correctly, that means you only spent your money when you acquired the property, and all the vacancy and maintenance is paid by the cash flow reserves. Our model is helping the average investor accumulate somewhere between 5 and 10 units over around maybe a 5 to 10 year period. So not overnight, and we do this kind of in a step-by-step process to help investors build a diversified portfolio. Asset protection is a combination of property management and insurance, which we have presentations on both property management and insurance on our website. And, we have this rule here that, we only sell and manage properties that we feel each one of our staff members would be comfortable walking our dogs at night. Generally speaking, if we're in an area that we're not comfortable, us or our wives or sisters or brothers or grandparents, walking around at night, that's probably not going to be an area that we're going to see success over time in owning that property. It's a rule of thumb. It doesn't mean it's accurate 100% of the time. It is probably accurate a very high percent of the time. But generally speaking, if we're not comfortable, then maybe the good quality tenants might not be either. Lastly, I'm going to leave you guys with the potential risks associated with real estate that we all want to decrease: vacancies, maintenance, property value fluctuating, and natural disasters. Well, this is exactly how we decrease the chances of each of these risks happening. Higher property classes have lower amounts of maintenance and vacancy. Buying in a major metropolitan market that has a much larger tenant pool will help us have a lot more options to fill our vacancy. Hiring professional property management will obviously be able to be our weapon and our tool to be able to do everything correctly and really decrease that vacancy so everything is done by the book. We will make sure that you get a home inspection when you buy a property from us. It'll tell us the condition of every component in the property. That'll help us figure out if we should even move forward with closing on that property. Higher property classes have lower amounts of maintenance over time. And of course, new properties or turnkey properties that have had major renovations will also see less maintenance over time. Property values, if we're in a market that has good, strong job growth, diversity of employment, many different industries, if we're in a very business-friendly market, as long as we can put somewhere maybe around 20, I'm going to say between like 20 to 40% down to ensure positive cash flow, as long as we have positive cash flow, then we can go through the fluctuations in values over time and hold it long enough to where those values do come back. And lastly, as long as we have the adequate liability coverage and proper coverage in our insurance policies, then we are protected against natural disasters or claims coming from tenants. And really, this is what we want each of our clients to look like when they buy a property with Marshall Reddick. That was me, 12 or 13 years ago when I bought my second investment property in Phoenix, Arizona. It was a hot day, and I only stood out there for a second, and I jumped right back in my car. I was very happy. I had just closed escrow on this property. It was the fourth property I made an offer on. I was not emotionally attached to the properties I looked at. I was emotionally attached to my criteria. So if a property did not fit my criteria, I just moved on to the next one. There was really no emotion in it, and it's because I was very analytical and I knew exactly what kinds of properties I was looking for. I do recommend that you guys go on our Learn page to be able to download those calculators, watch some of our videos. And finally, at the very end here, I hope you all get a chance to connect with Sherry Brebner, an amazing real estate advisor on our team, who can take as long of a call or short of a call, and that can turn into a second, third, fourth, fifth call. And that can go as far as possible until we've helped each of you achieve your goals, no matter really what that entails. So I thank each of you. I apologize for going a little bit past the hour here. I do hope that you guys were able to gain a lot of value from this presentation. And Dimitri, again, thank you so much for letting me speak.
Okay, Scott, thanks so much. A lot of great information, a lot. Probably need to rewatch this, but we did record that and it will be available for viewing. Let's see if we can just get one question. We got several, but because of the time, I want to be respectful of you guys. Question, John is asking, do you offer non-recourse loans?
Yes. Yes, we do. That's something that you certainly talk directly to our private lending team about. I guess without getting into too much detail, the easy answer is yes, we do.
Okay, great. Well, thank you so much for joining us. I wish everyone to have a good night, and we look forward to talking to you soon.
Thank you, Dimitri. Thank you, attendees. And we look forward to connecting with you all soon. Thank you, everybody.
Good night, everyone.